Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about SentinelOne. SentinelOne reported their Q4 2022 results last night, and I'm just going to go through that. So SentinelOne is a cybersecurity company. This is a space that investors are very much excited about. So I'm going to talk about some of the aspects here that are good and some of the aspects that are bad, okay? So ultimately, what they talked about on the earnings call is how the extended detection and response platform is really allowing them to grow at a substantial rate. So they're guiding to grow over the upcoming year by more than 80% year over year. So this, despite it growing really, really fast, I make the case that this is actually already pricing in a lot of optimism. So particularly when we consider just how unprofitable this business is. So that's the takeaway here, and yeah, let's dig into some details. So it's a growth name, it's a tech name. It's pretty much it's down 40% in the last several months. It's how a lot of these names have been in the past. Back in December, before the sell-off, I said that I'm unfazed by these growth rates and openly declare that this stock is overpriced for what it is. Investors are asked to pay more than 30 times forward sales for a business that will not be reporting any profitability anytime soon. Investors would do well to pass on this name. And yeah, since I wrote that, the stock is down. If we include the after hours sell-off of 5%, the stock is down 40%. And today I kind of largely echo that stance, but I do remark that there are some positive elements starting to percolate here. So, as already talked about in the introduction, revenue growth rates for the upcoming year to grow at 81% year over year. Okay, so this is a growth story. They needed to report growth, they needed to be guiding for strong growth, and that they have done. Okay, so on that front, whatever they set out to do, they're delivering against that. Okay, on the other side of the equation, you have to remember that this guidance is actually 7% above what analysts were expecting for the upcoming year. So for them so early on to be guiding for such a strong beat for the upcoming year is a sign of confidence of management. They're more likely than not going to be upwards revising that guidance as the year progresses. So from that perspective, there's a lot to like here. So there's a lot. What Sentinel does is actually it's an endpoint detection platform. Okay, so you're able to, what it distinguishes it from other cybersecurity companies, it's an out-of-box solution. Okay, so it's able to get you up and running much quicker than other ones where you have to kind of have a consultant come in and discuss and all that kind of stuff. So what it does very well. Okay, and to that extent, we see the number of customers increasing by more than 70% year over year. Okay, so that's obviously very good. That being said, if we look back a quarter ago, so at the end of Q3 21, the number of customers was up 75%. So there's been a slight deceleration in the customer adoption curve, and if I was a shareholder here, that would be something that I'll be looking out for. You want to see a consistent amount of customer adoption. You don't want to see it decelerating over a 90-day period. That's something you just kind of like keep your eye on it, because ultimately you don't want to be in a situation where your platform is only able to grow its revenues via price increases as it sells more services to its existing customer base. You want to see at this stage in the game, you want to see growth coming from the customer adoption curve, because that's the sign of a healthy business that has broad reach. Okay, so this is the blemish here. They made a lot of progress and talked about it on the call, how they slowed down their growth rates to allow themselves to easily improve their bottom line profitability. And we can make a case, the market's kind of like willing to kind of embrace this story. And what they're saying essentially is that if you think about it on a non-GAAP basis, we're doing quite well. But the problem you've got here is that your stock is down, and you're offering everyone a lot of stock-based compensation, but everyone thinking is okay, my stock compensation isn't worth that much. It's kind of was worth a lot when I kind of took on this project, but now over time the stock has fallen. It's not worth that much. If they want to retain somebody, they're gonna have to pay them in cash, and so at some point in time, that non-cash expense will have to become a cash expense, and then you start to think yourself, okay, for them to grow the top line by 100%, they're having to incur losses of 100%. So it's like, it's one thing to be able to grow your business fast, okay? It's another thing to grow your business profitably fast. That's a whole different strategy, and I still have a question mark here. So I think that if I wanted to put a positive slant on it, I would say that on the best case scenario, fiscal 23, they're going to be reporting negative 55% non-GAAP operating margins. But as I already talked about, yes, there is a strong improvement from how they finished the year. So they finished, I think it was at I can't remember now, to be honest. I think it was minus 60 or something thereabouts. So it's going to be an improvement for the upcoming year. But so it's actually finished the year at negative 130%, sorry, and they're going to be guiding for negative 55% for the upcoming year. So obviously that's a strong improvement, but as the year progresses, if that share price does not take up, then you're going to have to issue even more stock to keep management here working. And if you want to get new talent on board, you're going to have to do that as well. So it's something that kind of like you can argue this on two sides of the equation. If this was 2021, everyone would be like, yeah, man, revenue growth rate. But now people are like, yeah, show me the money. So yeah, with that, let's continue. So this is what I've been kind of alluding to for a while now. This data compares the price to sales ratio looking forward for SentinelOne and for CrowdStrike. For SentinelOne, the estimates only started coming in February, so for its forward year, so because it's a newly public company, so that's why the graph kind of looked kind of like half cut off. But what you're seeing here is that in the past few months, SentinelOne's price to sales multiple went from 36 times forward sales to approximately 23 times. Now it's kind of closer to 21 times because the guidance for the upcoming year is even stronger than this. But for all intents and purposes, it has come down substantially from 36 to down to 21. Meanwhile, in the case of CrowdStrike, is that case that, as I've been alluding to, if you have the belief of your shareholder base that you're going to be reporting substantial profits in the near term, investors are going to be quite happy with that. And you can see here, since February, in that same time period as we just discussed for SentinelOne, over that time period, the price to sales multiple has remained at 21 times forward sales for CrowdStrike. So investors are really much saying, okay, you show us the money and we'll support the share price. And if you don't show us the money, then we're not going to be that enthused about it. So that's the overall takeaway here. So I think that overall, I believe I'm very interested to see how this unfolds in the next several weeks, because the market, I think that the market is kind of being a bit too permissive at the moment, and I think that there's a lot of different macro scenarios that's kind of don't want to really go into right now, but there's a lot of different things happening on the background that I think the market is kind of too easygoing about it. So in any case, I really hope that you found this useful, and if you want to find out what kind of names I'm buying, don't forget to check out my marketplace right there above the screen. Deep value returns. I highlight for you high quality, actionable investment insights. Thank you so much for listening, and I'll see you next time. Bye-bye.